Tesla just delivered more than 480,000 vehicles in a single quarter, but there's a massive problem investors simply cannot ignore. Yes, Tesla's revenue surged, yet their operating margin has completely collapsed to just 1.4%. So the real question we have to ask ourselves today is Tesla's delivery rebound actually bullish for shareholders?
To understand exactly what's happening under the hood at Tesla, we have to look at the stark contradiction between top-line growth and bottom-line profit in their Q2 2026 earnings. It's like looking at two completely different companies. On the boom side of the equation, you have massive scale. They delivered 480,126 vehicles, driving top-line revenue to a staggering $28.24 billion. And energy storage, that hit a record 13.5 gigawatt-hours. But when you flip to the collapse side, the picture changes dramatically. Total gross margin fell to 16.8%. Operating margin, as we mentioned, plummeted to 1.4%, leaving an operating income of just $398 million. All this trickled down to a non-GAAP earnings per share of just 33 cents and a deeply negative free cash flow of $1.09 billion. Even regulatory credits were down to $146 million. For anyone holding this stock, understanding this bizarre contradiction is absolutely crucial right now.
Okay, let's dive into Section 1, the Q2 delivery boom. We'll start by validating the undeniably positive news that grabbed all those initial headlines. What's really impressive here is the sheer scale of the volume recovery. If you remember, Q1 of 2026 was a remarkably weak starting point. Tesla delivered just over 358,000 vehicles. But in Q2, they bounced back aggressively to 480,126 deliveries. That is a roughly 34% jump quarter over quarter, and a 25% year-over-year increase compared to the 384,000 vehicles they moved in Q2 of 2025. And crucially, it absolutely crushed the pre-quarter Wall Street consensus, which was sitting at around 406,600. This rebound is a fantastic signal because it proves Tesla's execution and consumer demand can recover incredibly fast after a slump.
But if you're a newer investor, just looking at those volume numbers, I want to give you a quick word of caution. One strong quarter does not automatically prove a sustained growth cycle. The next real test is whether Tesla can maintain healthy deliveries in the third and fourth quarters without having to rely on aggressive price cuts or unusually favorable timing. High delivery numbers are great for sure, but they are only half the story. Let's move to Section 2, unpacking the margin collapse. We need to peel this onion to the next layer and figure out why 26% revenue growth did not lead to an actual increase in operating profit. To really get this, we need to make sure we're clear on two foundational metrics. Gross margin is basically the profit remaining after you subtract the direct physical costs of building the cars. Tesla's total gross margin came in at 16.8%. But operating margin goes a critical step further. It's the profit that's left over after you also subtract research and development, sales, and administrative spending, the whole shebang. The simplest way to put it, Tesla is selling a lot more cars, but right now they are keeping way less profit from every dollar of revenue they bring in.
You can really see the severity of the squeeze when you look at it year over year. In Q2 of 2025, Tesla's operating margin was 4.1%. Fast forward to Q2 of 2026, and it is plummeted to just 1.4%. Think about that. For every $100 of revenue Tesla generates, they are only keeping about $1.40 of operating profit before interest and taxes. That is a razor-thin margin for a company valued at over $1 trillion. So what exactly is driving this severe compression?
While one major culprit is the sharp decline in regulatory credits. A year ago, Tesla brought in $439 million in automotive regulatory credits, but in Q2 of 2026, that number dropped by about 67% to just $146 million. Now, why does this matter so much? Because these credits carry essentially a 100% profit margin. So when they disappear, it disproportionately damages the company's overall profitability, even if physical vehicle volume is going up. We also have to talk about pricing pressure. Tesla's reported automotive gross margin was 16.9%, but when you strip out those high-margin regulatory credits, the core automotive gross margin drops to about 16.3%. A massive delivery quarter is awesome, but if it's achieved through steep discounts, cheap financing incentives, or selling a mix of lower-cost vehicles, the underlying economics suffer. And this is exactly why savvy investors look beyond headline deliveries to evaluate revenue per vehicle and the actual cost to produce each car.
Section 3, the free cash flow problem. And this brilliantly illustrates the next major issue we need to tackle: the impact this margin squeeze is having on Tesla's actual cash reserves.
For Q2 2026, Tesla reported a negative free cash flow of $1.09 billion. Yes, negative $1.09 billion. This is a stark reversal from the robust positive cash generation that investors have grown super accustomed to with Tesla. And listen, cash generation is vital. It's the ultimate test of a company's ability to self-fund. Even when your top-line revenue is surging, burning over $1 billion in a single quarter is a major red flag that requires some immediate context.
The context here: exceptionally heavy operating expenses. Tesla is aggressively pouring billions into artificial intelligence, full autonomy, and their Optimus robotics program. Management is making a deliberate, highly capital-intensive choice. They're willingly sacrificing today's operating margins and free cash flow to build futuristic businesses that they believe will yield massive, software-like margins tomorrow. It's a really difficult near-term trade-off for shareholders to digest.
Now, if you're finding this Tesla earnings breakdown useful, make sure to subscribe to Fox of Wall Street, share this explainer with another investor, and like the video. It really helps us bring you more data-driven stock analysis just like this. Moving on to Section 4. Energy storage and diversification. Let's shift our focus to one of the most exciting, bullish signals in this entire earnings report. Tesla successfully expanding its business beyond just making cars.
Tesla is proving that it is much more than an automaker. In Q2, their energy generation and storage revenue hit a massive $3.14 billion. This is a huge deal. With intense pricing pressures squeezing their automotive margins, having a highly profitable secondary growth engine is strategically vital for the company's financial stability.
And the sheer scale of this energy growth is just incredible. Tesla deployed 13.5 gigawatt hours of energy storage in Q2. To put that into perspective, that represents over 40% year-over-year growth. If Tesla can continue scaling this segment while gradually stabilizing its car margins, the overall long-term investment thesis becomes significantly stronger. Section 5. Pricing Tesla's future valuation. This naturally leads us into the most debated topic on Wall Street right now. How exactly does the market value this stock? Tesla is trading at roughly a $1.1 trillion market cap, despite those razor-thin 1.4% operating margins we just talked about.
To make sense of this massive premium, you have to separate Tesla into two valuation buckets. Bucket number one is the present-day automotive business, which, as we've seen, is really under pressure right now. Bucket number two is the massive option value investors are assigning to Tesla's future ventures: AI, autonomy, robotaxis, robotics like Optimus, and that booming energy storage segment. The stock remains incredibly expensive on conventional earnings metrics precisely because the market is already pricing in the future commercial success of these revolutionary technologies.
But herein lies the risk, right? The future narrative versus the underlying financial evidence. If the hype outpaces actual measurable commercialization and cash generation, the valuation risk goes through the roof. Investors also have to monitor regulatory risks that can shake up this narrative. For example, just look at the August 21st China recall involving nearly 3 million vehicles. While the financial impact of that specific software recall is still pending, it's exactly the kind of operational hurdle that can rattle a valuation built on future perfection.
Section 6. Bull versus bear outlook. To navigate this complex landscape over the next few quarters, we need a clear, completely impartial framework.
Rather than just cheering for big headline delivery numbers, sophisticated investors should be using a checklist like this. Yes, track vehicle deliveries, but immediately cross-reference them with auto gross margins excluding regulatory credits. Keep a hawkish eye on operating expenses and free cash flow to ensure those massive AI investments aren't bleeding the core business dry. And finally, watch for tangible proof of energy growth and AI commercialization while constantly weighing competitive pricing pressures against the stock's current valuation. When we look at the data side by side, the arguments are incredibly well defined. The bull case points to a phenomenal delivery recovery, a rapidly expanding energy business, and the immense potential of AI and autonomy to eventually stabilize margins. The bear case, on the other hand, points to relentless pricing pressure, undeniably weak automotive margins, declining regulatory credits, negative free cash flow, and high operating expenses that make the current valuation exceedingly difficult to justify. Ultimately, the most accurate way to summarize Tesla's Q2 2026 earnings is this: volume recovery without a corresponding profitability recovery. The core auto economics are currently taking a backseat to defending market share and making massive capital investments for the future. So the single most important question every investor must ask themselves right now is this:
Can Tesla convert this higher volume into durable cash earnings while continuing to fund its AI and robotics future? The next several quarters will give us the answer, and we'll be here tracking the data every step of the way.